This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, so let's go through and start your strategic business reporting, your SBR journey, by going through and looking at the revised conceptual framework. You should be familiar with the conceptual framework from your studies that you've done, whether that was in F7 or the slightly updated financial reporting. So the next few videos that we have should effectively be a little bit of a revision, but then taking account of the updates that have been made to the new conceptual framework. So let's go through and just briefly recap why we have that conceptual framework and what it's all about. Because effectively, your conceptual framework provides you with the ground rules, the basics, the essentials that underpin everything to do with your IFRSs. So it's used there when we are making updates to accounting standards or when we are developing a new accounting standard. So if we think about some of the recent accounting standards that have been updated, we are thinking about revenue and IFRS 15. We're thinking about leases and IFRS 16. Those standards will have been updated to ensure that the rules within those specific standards match what we have with the basic rules, the basic concepts within the conceptual framework. As it stands with regards to strategic business reporting, the conceptual framework going forward will still carry on to be a part of the syllabus, but at this moment in time, where it sits within the syllabus tends to start thinking about it being a current issue, because effectively the framework has been updated. So that's one of the current topics that we have there within your strategic business reporting. The good news, as I said, is that you should be familiar with it. So therefore, it shouldn't be too technically difficult with regards to bringing forward that knowledge that you have from financial reporting. However, the examinability makes it a little bit more of a challenge, because if you go through the suite of your exams, so you've started off with F3 or financial accounting in its current guise, and that was testing everything with regards to the knowledge of the framework, so looking at the definitions and ensuring that you could regurgitate or had learnt those definitions, whereby then into financial reporting or F7, if that was what you sat as an exam, it was more focused on the application, but application linking to the standards that you'd seen in financial accounting and also within financial reporting. So you were having to apply the rules and the criteria of the conceptual framework to scenarios relating to, say, inventory and IS2, property, plant and equipment and IS 16, some of the more complex standards that you saw within FR, so thinking about provisions and IS 37, intangibles and IS 38, and even, and you don't see it much in financial reporting, but financial instruments with regards to IFRS 9. You saw lots of financial instruments in financial reporting, thinking back to convertible debentures, financial assets, fair value through profit or loss, fair value through OCI, but you never really had to apply them specifically within a question. This is where SBR develops you as an individual as you grow and mature into becoming a fully qualified certified accountant. So what you have there is you have to apply not just the rules and the criteria of the framework to the specific standards that you've seen in FR, but also some of the new accounting standards that you touch upon that you see within the strategic business reporting syllabus. So things such as pensions and IS 19, share-based payments is there IFRS 2, and effectively as well IFRS 8 is that operating segment. I'm not going to name them all, but you get the idea. It's all about the application. So whenever you go through a chapter within our class notes, do make sure that you think back to the framework and how those rules and criteria may apply. For those of you who have done financial reporting or F7 previously and are familiar with the old framework, don't panic. There haven't been massive changes. It's not as if we're starting from a blank canvas. The canvas that you have effectively is pretty complete and things just need rubbing out and rewritten. So what you've got there in terms of some of the newer areas that are included is we have some additional new areas with regards to your measurement bases. So don't worry so much about the fact that we record things at historic cost. That still stays there. But we bring in now what is referred to as your current value, and that starts to look at things in a little bit more detail with regards to fair value accounting, value in use, fulfillment values, and current costs. There's a chapter that's been included as well within the conceptual framework about your presentation and disclosure. It's not very exciting, okay, but effectively that just goes through and starts to look at your other comprehensive income and starts to give us a little bit of the fundamentals about when we recognize something within other comprehensive income, when and where does it get reclassified. There's a little bit about derecognition. So the old framework tended to focus on recognition. Now there is a small section there upon derecognition. Again, not very exciting or too interesting, but it's nice and simple, which is great. You've also got updates to do with the definitions of assets and liabilities. Here's a test. Oh no, yeah, here's a test. What was the old definition of an asset? Sort of, you sort of get in there, okay? Yeah, the definition of an asset was a resource controlled by an entity as a result of a past event. There's been a slight update to that definition, just with regards to the terminology around the word resource. You can see what the next test is. What's the definition of your liability? Yeah, that was a bit better than what you had on your asset. Yeah, so your definition of a liability was a present obligation that gives rise to an outflow of economic benefit, and also there was it based upon a past event. Okay. Sound familiar? We've just changed that definition of a liability. Okay. Instead of a transfer of economic benefit, it's a transfer of an economic resource. Okay. So minor updates there. The recognition of your assets and liabilities. Yeah, here's a test. What was the old recognition criteria? Excellent. You've got one of them. Yep, that's it. Okay, so you're going to go through there. The recognition of an asset was there, and that was a probable inflow of economic benefit, and you could measure it reliably. And then the liability, it was a probable outflow of economic benefit, and you could measure it reliably. Again, that definition has changed with regards to your recognition of the assets and liabilities, and it all comes down to something being recognized now if it provides you with more relevant and faithful information. So effectively going back into the qualitative characteristics and looking at your fundamental qualitative characteristics of relevance and faithful representation. Okay, it's quite handy there that we mention your qualitative characteristics and your fundamental qualitative characteristics of faithful information or faithful representation and relevance, because that then ties in to starting to look at the clarification aspects on measurement uncertainty and prudence. So therefore, because we've taken, if you like, out from the recognition criteria that element of recognition relating to measure reliably, we need to then think about, okay, if we can't measure something reliably, what do we do? How does that then fit into the definitions of our qualitative characteristics? So we think about your measurement uncertainty and how that impacts the faithful information that we're trying to demonstrate within our financial statements. Also, prudence is reintroduced by definition as part of your faithful information. So prudence didn't appear within that previous version of the framework, and there were calls for it to be re-included. Back in the updated version, those calls have been listened. We've also got the clarification in terms of stewardship and the effect there that you have your owners of the business are not the managers of the business. The owners are the shareholders. The people who run the business are the directors. They are effectively the stewards of that business because they are running it on a day-to-day basis. So therefore, the framework needs to give us information that we should be looking at as a shareholder to judge that stewardship of the business. So effectively looking at the performance, the position, and the changes in your financial position. And then there's a little bit of clarification as well upon your substance over form, particularly with regards to then linking it in to some of the later accounting standards, and when we begin to look at groups and is it there, other areas where we think about your substance over form. Okay, but we'll save that until later. But what I'd recommend is I recommend you go through the following videos, even though you probably know a lot of the information already. I've covered the updates there. We'll talk about them in a little bit more specific detail as we work our way through the individual chapters of the updated ISB conceptual framework. Enjoy.